stop trading until you learn this rule. I mean that. If you've been following my talks, you'll remember the previous video on 3 ways to identify a trend reversal early. That lesson was about reading the market's language before it shouts. But this is about knowing when not to trade at all. You see, every losing trader I've ever met has one thing in common: they couldn't wait. They just had to be in the market. They thought being active meant being smart. It doesn't. It just means you're impatient. Now let me ask you something. Have you ever looked at a chart and thought, well, it's moving, I better get in before it's too late? That feeling, that rush, that's the death of most accounts. The rule I'm talking about today separates the professionals from the public. And it's simple. Don't trade when there's nothing to trade. Sounds obvious, doesn't it? But it's the hardest thing in the world to do. The market doesn't pay you for effort. It pays you for waiting for the right moment and acting only when everything lines up. If you don't have a clear line of reasoning, a clear setup that fits your tested method, you're gambling, not trading. Let me tell you, when I first started, I thought I had to be in the game every day. I'd look at the tape, and if I didn't make a trade, I felt like I was missing the action. I didn't realize that staying out is a position too. The hardest part of trading isn't taking a loss. It's doing nothing when the market tempts you with noise. That's what I mean by stop trading until you learn this rule. Now you might be thinking, but Jesse, how do I know when not to trade? The answer lies in your preparation. If you've studied your charts, if you've read the tape, and you can't see a clear direction, don't try to invent one. The market's story isn't always written yet. You can't force a chapter that hasn't been printed. I used to sit for hours, sometimes days, doing nothing but watching. People around me would trade every squiggle on the board. They'd laugh when I stayed still. But when the time came, when the trend revealed itself plain as day, I was ready and they were exhausted. The market rewards patience, not participation. Do you know why most traders lose? Because they can't sit tight. They don't understand that the best trades happen once or twice in a month. Not every morning before breakfast. The amateur wants to eat 3 meals a day from the market, but the market doesn't serve on a schedule. Remember what we discussed in that previous video on trend reversals, how the earliest signs of a turn are subtle, quiet, almost invisible. That same patience applies here. If you can wait long enough for the market to show its hand, you'll never need to chase. The moment you chase, you've already lost your edge. Another question for you. Do you keep trading because you're certain, or because you're afraid to be left out? That's a tough one. Most won't admit it, but fear of missing out drives more trades than strategy ever did. You see a candle break a level, you think, this is it. But if you haven't confirmed the volume, the context, the broader trend, you're just reacting. And reaction is emotional. Trading should never be emotional. I learned this rule the hard way. Every time I broke it, I paid tuition to the market. That's what I call losses. Tuition. You're always paying for your education in this business. The only difference is whether you learn the lesson or not. When the tape is dull, when prices drift without conviction, that's when you should tighten your grip on your capital. Because dull markets breed false signals. They make you think something's happening when it's just the market breathing. Don't mistake noise for opportunity. A good trader's job is to wait until the odds line up so well that the trade almost feels obvious. That's when you act, and that's when you make your money. Every other time, you protect it. You'll never go broke waiting for the right moment, but you'll go broke trying to trade every moment. And let's be honest. How many times have you entered a trade just because you were bored? Maybe the day felt slow. Maybe your last trade stopped out and you wanted revenge. You told yourself, just a small position this time. But that's how it starts. The small, harmless trade becomes a habit, and habits become ruin. The market punishes neediness. Trading isn't about being right all the time. It's about being selective. You can be wrong half the time and still come out ahead if your timing and discipline are sound. That's why this rule matters. It protects you from yourself. The best money I ever made came from trades I waited weeks for. The worst came from trades I entered because I felt I had to do something. There's a strange kind of comfort in activity. It tricks the mind into thinking progress is being made, but markets don't care about your feelings. They only respond to structure, volume, timing, and trend. When you learn to see that, you start thinking differently. You start to understand that wealth isn't built from one lucky move, but from a series of disciplined decisions. And just as many disciplined non-decisions. You protect your capital as fiercely as a general guards his last battalion. Because that's what it is. Your capital is your army. You send it into battle only when victory seems almost certain. And if the battlefield is unclear, you stand still. You wait. You let the other soldiers exhaust themselves first. The tape will tell you when the tide has turned. It always does. But only to those who can listen quietly enough to hear it. Do you remember how we talked about spotting reversals before they're obvious? Well, this rule is the other side of that coin. Sometimes the smartest trade is the one you don't take. The market whispers before it shouts. And if you can't hear the whisper yet, you've got no business making noise yourself. Patience isn't passive. It's preparation. Every moment you spend out of the market, you should be sharpening your tools, studying price action, refining your system, understanding where the next big move might form. When that moment arrives, you won't need to guess. You'll recognize it. You see, trading is a business of waiting. Waiting for the right signal, the right price, the right moment when risk and reward finally tilt in your favor. Until then, you guard your resources, you keep your mind clear, and you refuse to be seduced by movement that means nothing. The best traders wait for the market to show its hand. That's a rule written not in theory, but in the blood and sweat of every serious operator who ever stood before a price chart or watched a ticker tape spin. You can't rush the market into revealing its direction, any more than you can rush the seasons to change. The market moves when it wants to move, not when you want it to. And the traders who survive, the ones who last long enough to make real money, are those who've learned how to wait. When I say wait for the market to show its hand, I mean this: don't act until the market itself tells you where it intends to go. Most traders lose because they're trying to outguess it, to predict instead of confirm. They jump in because they think they know what's coming next. But the market doesn't pay you for guessing. It pays you for understanding its behavior. Have you ever watched a poker game? The rookie tries to bluff on every hand, thinking he can outsmart the others. The professional waits. He studies his opponents, their patterns, their tells, their rhythm, and when the right card falls, he moves with conviction. That's exactly what you must do with the market. Price action, volume, and structure. That's the hand the market plays. Every move it makes is a clue, a gesture, a signal. The amateur reacts too soon, but the professional waits for confirmation. If a stock is trending upward but the volume is fading, it's not showing strength, it's showing exhaustion. If price breaks a key level but quickly reverses, that's not a breakout, that's a trap. The best traders don't chase these false moves. They let them unfold. They let the story play out until it's clear who's winning, the buyers or the sellers. Now ask yourself, how many times have you entered a trade too early, only to see it reverse the moment you clicked buy? Every trader knows that feeling. You spot what looks like a strong move, you don't want to miss it, and suddenly you're underwater before you can even think. That's what happens when you act before the market has shown its hand. You're trading what you hope to see, not what's actually there. The truth is, the market always telegraphs its intentions, but it does it quietly. You've got to learn to read the subtleties, the hesitation before a breakout, the acceleration after a breakout holds, the change in rhythm when volume expands at the right moment. You'll never see these things if you're too busy clicking buttons. The trader who's always in a position is never in the right one. When I was younger, I made that mistake often. I wanted to be active. I thought trading meant always having a stake, always making a move. But the best trades of my career were the ones I waited for. The setups that took weeks to form, that tested my patience, that made me doubt whether the move would ever come. Those were the trades that paid. You see, the market rewards the observer, not the aggressor. You can't force opportunity, you can only recognize it when it arrives, and it doesn't arrive often. The big moves, the ones that make your month or even your year, are rare. They don't happen every day, and they don't announce themselves with fireworks. They start quietly, with a subtle shift in trend, a change in volume, a pattern that looks ordinary until it's not. That's why you have to wait. You wait for the price to act in harmony with your setup. You wait for confirmation that the tide has truly turned. Until then, you sit tight. Do you remember how we talked in that previous video about identifying trend reversals early? Well, this principle ties directly to it. The skill of spotting a reversal is worthless if you act before the market confirms it. Early recognition is only valuable when paired with discipline. The difference between a good entry and a premature one is often just a few bars, but that gap can mean the difference between profit and pain. Patience in trading isn't passive. It's one of the hardest forms of discipline you'll ever practice. Waiting doesn't mean doing nothing. It means watching closely, studying every move, preparing mentally and strategically for the moment when your setup finally clicks. The waiting period is when you refine your plan, your entry, your stop, your target. You prepare so that when the market finally shows its hand, you can strike without hesitation. And when that moment comes, you'll feel it. The chart aligns, the pattern confirms, and everything you've been watching falls into place. That's when you move, not before, not after. The amateurs are always too early or too late because they don't trust the market to tell them what to do. They let their emotions decide. Fear and greed. Those are the enemies of patience. Ask yourself, are you waiting for the market, or are you forcing it to give you something it's not ready to give? Because the difference between those two mindsets determines your outcome over the long run. One leads to control, the other to chaos. A trader who waits for confirmation isn't weak or hesitant. He's confident. He knows that his capital is his most precious asset, and he won't risk it without clear evidence that the odds are in his favor. The market gives clues, not certainties, but those clues become clear to the trader who's patient enough to let them develop. You must remember, every great move in the market has a moment when it becomes undeniable. That's when the market has revealed its hand. The trend is clear, the momentum is confirmed, and the crowd begins to see what you've been waiting for all along. If you enter before that moment, you're guessing. If you wait for it, you're trading with the flow. There's an old saying, it's not the buying or the selling that makes money, it's the waiting. That's as true today as it was 100 years ago. Waiting for the market to show its hand means trusting the process, respecting the rhythm of price movement, and accepting that time, not impulse, is the key to consistency. Staying out of the market is a valid trading position. Most traders never truly understand that. They think trading means constant action, constant buying and selling, always being involved, always doing something. But the truth is, the best traders spend more time not trading than trading. The market doesn't pay you for effort. It pays you for timing. And sometimes the best trade you can take is no trade at all. You see, when you're sitting in cash, you're not out of the game. You're simply waiting for the odds to stack in your favor. Every great operator I've ever known understood this deeply. They didn't look for trades every day. They waited for the market to come to them. The amateur tries to force opportunities, like a fisherman thrashing the water hoping to scare up a catch. The professional knows that the fish come when they come, and his job is to be ready when they do.